Afternoon, so I think we'll go ahead and get started. Today, this is our second, so you guys are the second group that we've had in for our series, Meet the Investor. So very much appreciate you devoting your time to this hour. But we have the Cascade Seed Fund today out of Bend, Oregon, which obviously has some similarities to our region in terms of size, quality of life, et cetera. And I've known Robert. Robert, you and I met, maybe early 2000s at a company in Seattle, MessageGate?
That's correct. That's correct.
And then reconnected a couple of years ago at an angel conference in Boise.
Yeah, right.
So they're a bit like the Kickstart funds that I manage here in Spokane on the earlier spectrum. But rather than steal their thunder, I'll turn it over to Julie and Robert to tell us about your backgrounds, your fund, your criteria, and any other kind of preliminary comments that you'd like to share with the group. And then we'll turn it over to questions and answers, and really encourage participation from the audience. If you have questions, you have two choices. You can just kind of raise your hand when they're done with their comments, or you can send them to me and I will queue you up. So that'll be the process when we get to the Q&A part of it. But I'll turn it over to you, Julie, and tell us more about the Cascade Fund.
Yeah, thank you so much. So appreciate everybody's time today and the opportunity to speak with you. Robert and I, when we do these sessions together, we think of them a little bit as a combination of car talk plus between two ferns. So we like to take this pretty informally. And so if people have questions, please start thinking about those now. And we'll talk a little bit about the fund. So Cascade Seed Fund is a seed stage investment fund with a focus in Oregon and more broadly the Pacific Northwest. We have about $12 million under management. We've done 37 investments. And where we tend to invest is just after the friends and family money. We're typically in that first initial institutional money that is invested in a company. So the company has a team, has good leadership, and has some early traction. I think one of the things that we've noted that has distinguished our fund a little bit from other funds is that we are both entrepreneurs. So I think we have about 12 startups between us ourselves. So we know the pain of raising money. We know the pain of managing cash and trying to make payroll. We know the enthusiasm, the optimism of really trying to take an idea and turn it into something that is profitable and successful at many levels. That's the 75 words or less version, and I'll pass it over to Robert for some additional background.
I think it's incredibly well said, Julie. I guess what I'd add is that one, it was awesome to reconnect with Tom. That was in Boise at an angel event, and so the company he and I met at was my first executive job I ever had in a startup, and so I've done 6 startups over 20 some odd years, and I really was bad at raising money when it was finally time for me to do that. And I did not raise money, and then I still think I was really bad at it and did. And so some of doing this, and I started working with Julie in 2016. She started the Cascade Angels Fund at the time in late 2013, early 2014, really to try to demystify this whole early process and kind of get at it from, one, we're a fund, so we want a return on investment, but really try to be transparent in process, be clear in feedback, and really kind of distill it down to what we look for in investments. And so we are, we're a regional seed fund. We're not in a major metro. We're in Bend, Oregon. Current fund is about $6 million in size. It's the largest fund that we've raised, but we're not shooting to raise larger and larger funds because it gives us some flexibility to invest in our region. So in other words, we're certainly not, we wouldn't refuse a unicorn, right? But we don't have to chase unicorns, right? We think about where the majority of venture exits are happening, venture-backed companies over the last 5 years, somewhere between 60 and $80 million, which is a lot of money. It's life-changing money, right, for entrepreneurs. So small funds can make money on those types of exits. If you're a $100 million venture capital fund or a $200 million venture capital fund, you have to have a giant exit. just to get that fund paid back and so everybody can make money. And there's a whole side of this business I didn't understand when I was on the entrepreneurial side as I get into it. So as we engage with folks, and as Julie said, we're generally in the first $1 million or so a company's going to raise externally. We're generally the first institutional dollars, which just means we ask for different things, which is part of, if you're raising money, you're going to learn a lot of the things around terms. But we boil it down to this, right? We sort of we're Oregon first, Pacific Northwest interested, which means we will invest in places like Spokane. We've looked at a lot of opportunities there. We then look based on kind of industry. So we invest in technology, right? Standard software, internet, all those different types of things. But we also invest in consumer products. And we parse that and we say we're much more interested in direct-to-consumer businesses as opposed to heavy retail. And then there's 3 boxes that we need to have checked to lean in on an opportunity. And this is just me trying to simplify this the best we can. Is, can you build the thing you think you can build? Which is, you've moved beyond concept and design and aspiration. There's actually a thing that exists. Does anybody care? Which means beyond your friends and your family and the people that don't want to hurt your feelings, that you've gotten this thing out into the market in some way. Pilot, trial, usage. You've been roughed up based on all the assumptions you made that need to be sort of either matured, verified, right, or removed. And then the third box we like to have checked is, does anybody care enough to pay, right? So we're not a pre-revenue investor, but that doesn't mean you need so much revenue that you don't need our money, right? It's this hardening that happens in a company when you go through the process of actually getting paid, right? So if you have a direct model, which is I knock on the door, I show you my thing and you buy my thing and I invoice you, that's a direct. But if you're doing something that's related to transactions or something that's related to volume, like that just helps you as the entrepreneur, because each of those 3 boxes you check increases the value of your company, so that when you come and you talk to folks like us, the price that we pay to buy into your company can be higher. So anyway, that was not really the question, but that's everything I wanted to say out of the gate.
I do like that, though. I do like that. And let's just talk about whether it's smart to raise money or not, because that's something we think about a lot. And I think if you're an early stage entrepreneur, and maybe you've all 37 of you that are online have thought this through, but if you think about entrepreneurialism as a spectrum, so you've got somebody who's a lifestyle entrepreneur. So I remember when I first moved to Bend, I decided to start this early fund. I knocked on the door of these guys who wanted to have a meeting with me, and nobody was there. And I said, "Where is everybody?" And the guy said, "Oh, they're gone. Where are they?" "Well, they're out kayaking because the water's in." And it was a lifestyle business, right? And really great business. Not necessarily investable because it wasn't going to show us the multiples that we need as an investment fund. Then there's a small business entrepreneur. So people that are on Main Street that have insurance businesses or florists or others, where they're not going to scale hugely, but they're going to make a great living for their family. They're going to be engaged in the community. They're going to do all kinds of wonderful things. Spokane, I think, and that surrounding area has similar quality of life as we have in Bend, and so you can do that. And then there's the folks that want to really work on something like be as crazy as the next, Google or Amazon. And we all find ourselves, and so as clear as you can be is where you are on that, and then what forms of funding you have available to you. Because when you take funding on from a fund like ours, it's really harder to get out of than a marriage. So if you make the wrong decision, you're really in trouble. And so we recommend that people be as clear as they can, as early as they can, what type of entrepreneur, what kind of potential their business has, and then really look, because bootstrapping and self-funding and debt and all those things are options. And taking money from a business partner like a venture firm or an investment fund like ours is a big deal. So where we look, and Robert said this really well around the 3 areas, can you build it? Does anybody care? Does anybody care to pay for it? Typically where we invest is in the sub $8 million valuation, and we invest $250,000. And that's on a combination of what are called convertible notes and also equity investments.
I really like what you said, Robert, about the ability to be able to have an attractive rate of return on an exit that's 60 to 80 million. And that's always kind of been my philosophy too, particularly when I'm investing in a smaller community where the likelihood of us having a Facebook or a Google is not very high. But there aren't a lot of other groups of investors that think that way. And because the larger venture funds, I just got done reading Scott Kapoor's book from Andreessen Horowitz, and really talking about they're just elephant hunting. They really are just trying to find that 1 out of 10 that is a multi-billion-dollar exit. And just kind of a long observation here, but that's not really in the best interest of a lot of entrepreneurs, particularly ones in smaller communities where, you know what, they might have a really interesting, compelling idea, and they might be able to get to 100 million in revenues in 5 years, which by my standards and Spokane standards and most growing a business standards is highly, highly successful.
Yeah.
But if you put a company like that in front of one of the Silicon Valley venture funds, they're going to drive you to a binary outcome where either, yep, they have a multi-billion-dollar exit, or by raising too much capital going too quickly, it's zero. And I think there's a place in between.
Yeah, no, again, this is sort of the nerd math part of this that as we looked at the platform, Julie started this and we looked at the Cascade platform, we looked at the type of fund, given where we not only are, right, because we'll invest in Portland, we'll invest in Seattle, generally states that touch Oregon, Boise, we've looked at some deals. But I think it's twofold, right? One, it's like, can we make a good return on the capital we're putting in place, right? We raise money from other people. We raise money from institutions, right? There's an expectation of return on capital. But also then it's sort of like doing that in a way that's not going to drive bad decisions, right? If it's like, it's either going to be a 0 or it's going to be 1,000, as opposed to it's going to be a meaningful exit that's going to return money to the investors, return money to the entrepreneur, return money to the community. What has to happen, and Tom, you've done this as well, right, is that you have to find people, Julie and myself and you, and that are crazy enough to do small funds. No one has any sympathy for the plight of the entrepreneurial fund manager, but funds make their money. There's a management fee. Think about it, you own a mutual fund in public markets, you pay a management fee on that. That covers, that covers allegedly salaries, that covers a lot of the operating costs, whatever it is. Well, the larger the fund, the more management fee there is. So you can pay yourself super well. So, Julie and I have been blessed in life and are at a stage where, this isn't about just trying to maximize our salaries. This is about trying to do good work, right? Make some money along the way. We're certainly capitalists. So that's one dimension, is the management fee. And the other of this is carry. And so carry is just the profit on the fund, right? So we've raised $6 million. Once we pay back everybody $6 million, then we share in the profits. The way we've structured our fund is that the traditional one is a 20% carry model, which means the investor gets 80%, the fund manager gets 20. We have an 85-15 split, right? So we are only taking 15% of the profit. One that's not totally being philanthropic, but that's the mindset of a few extra points for Julie and I are in life isn't that meaningful. But if we can produce those returns and put those back into the hands of our investors and back into the community for them to reinvest, right? So there's a flywheel, right, that has to come out of this. So, we're not an economic development group. I almost too many times I'll say the only thing we're ever going to remember by is how much return we generate, but there's a lot of really positive things that we can do along the lines, and really a believer in this type of fund model and this type of fund size, not only in places like Spokane and Bend, right, but just broadly, because I think it powers a type of entrepreneur that may get overlooked by the unicorn hunters, right? Because all capital, when you take it from a fund, regardless of our size, we want two things to happen. We want you to compress time, and we want you to accelerate growth. Yep. Right. And so whether if you bootstrap it or you're funding based on your customer revenue, it's kind of at your pace and the way you want to do it. When you begin to take outside capital, which is expectation capital, those things are going to compress, right? And the expectations are going to go up. So I think that's a I don't know where that moment of brilliance came to me one time when we were back and forth riffing, but that just felt like that's the pressure, right? You can go out and you can tell a big story and you can raise a bunch of money, and then you're behind the 8 ball, right? Because then you got to generate the returns. And
Well,
so
you and I have both seen a number of companies that drank the Kool-Aid of a Sand Hill Road firm, raised too much capital, and tried to grow too quickly to get that unicorn status, and imploded along the way. Whereas if they had been more prudent, maybe a smaller amount, and a little bit more thoughtful about their growth plans, may have had a chance to live another day. But your philosophy and my philosophy are very similar.
Yeah, for sure.
The other piece of that is not only raising too much money, but on very investor-friendly terms, right? So a lot of those terms are really predatory. And when you're a small business, or maybe you're a new entrepreneur, you don't necessarily know what you're getting into over the long haul. And I think that's a hallmark of a lot of these funds that have a regional focus, is the terms and the investors are fair, let's say, in order to develop that kind of entrepreneurial ecosystem.
Yeah, I'm a huge, go ahead.
Oh, you go ahead.
No, I was going to say, so I'm a huge fan of timelines. I don't know, just in terms of if you're thinking about, if you have a pitch deck, you're trying to sell something, to me, it's a visual way to lay out where milestones are in a business, and I need this to happen, this to happen. But I think you have to think about that also if you're an entrepreneur. Like, you start a company and people are like, you need to raise money. No, you need to have a plan. And the plan will dictate the capital needs of the business, right? And I think that helps significantly. And so when people say, well, I need to raise $1 million, it's like, well, why and for what? And again, this gets back to the less money you raise, the further you build your business, the more you can sell it for when you do take investor money. Right? And so I think the plan is such an important piece of this. And it may just be, I need $200,000 to get from point A to point B. But if you know there's a point C and a point D and a point E, like that's okay to fund that piece of the plan, but start with the plan.
That's really just another very insightful observation. I'm just, so many times I see companies who pick the amount that they need to raise to fit the market environment or what they believe the venture firms are targeting. That's their minimum or their sweet spot, and not really relating it back to their business. And I've always felt that's the wrong way to look at it, that you need to figure out the amount of capital you need to kind of get through either to cash flow break even or to get to a meaningful milestone such that you can raise your next round and do that with cushion. So, well, why don't we move on here? How do you source your investments? And, what is kind of the ideal way for, any emerging company, whether it be in Spokane or anywhere else? What's the best way for them to reach you or to reach another fund?
So a lot of our inbound referrals come from people that serve entrepreneurs, like lawyers, accountants, and so on. We get a great percentage of our referrals for deal flow from entrepreneurs because we have a reputation for being easy to work with. We have a defined process that takes 30 to 60 days. Everybody knows where they stand in the process. And the other thing that we did, Tom, is we decided early on that venture is kind of one of those things where you have to know a guy that knows a guy that knows a guy. And so we basically have done these rolling application periods. So anybody, when we have these open periods, anybody that goes on our site, our guest site, and thinks that they have meet the criterion that we have for investment can apply. And everyone that applies that meets that criterion gets a call with us. So we've tried to, for lack of a better word, democratize the process. And we have probably a couple hundred screening calls a year that we do. Robert, do you want to add some color on that? Or?
Yeah, no, really well said. I mean, something I was reading or listening to, I don't know, it's all a blur the last 3 months or so, was talking about, somebody asked this question of an interview of venture capitalists, and they're like, well, I like to see if people can figure out how to reach me. because, they'll have to build their business. They've got to figure out hard ways to reach people that are not reachable, or whatever the crap was. I was like, entrepreneurs have so much more important things to do than try to figure out how to reach an investor, right? I just thought it was really, So again, this is a little bit of this professional and personal vendetta in this thing. And when Julie and I began to work together, I just really liked this. It's like, look, we'll take a referral, right? Any point in time, right? Time you send us somebody to take a look at, we'll absolutely do it. Again, it's going to be through our lens, right? So we're clear on our qualification criteria. But these open application periods, there's a lot of people that are great entrepreneurs that think the deck is stacked against them. And in a lot of cases it is, right? And you got to suspend either your explicit or implicit bias you may have. One of the best examples of it wasn't really bias, but it just was frame of reference. So we're investors in a company called Slumberkins. Slumberkins is based in Vancouver, Washington. It's a consumer products company, right? It's basically plush toys and storybooks for childhood social and emotional development, right? Slumberkins. Now, this was a referral, not an application, but did end up coming through our application process. Mm-hmm. And I'm like, Slumberkins. Okay. So, but everybody gets a conversation if they meet the criteria. So I have this phone call with Kelly, who's one of the CEOs, one of the co-founders there. They're a co-CEO setup. And she's like, yeah, we're doing this thing. We've been, kind of doing this ourselves. And we got $1 million in revenue. I'm like, oh, and by the way, we've got these kind of margins, which were crazy. Oh, and by the way, we've extended this beyond just this, whatever, we've got this shopping deal with Henson Productions. They're thinking about creating an animated series. Oh, and my partner and I both have backgrounds in childhood social emotional development. We've been counselors. No, right? So had that conversation not happened, that realization that this was a great thing wouldn't have come together, right? Mm-hmm. And so that's why we think it is such an important part of this, which is, again, if you don't kind of meet our 3 buckets, we'll say, look, you're not revenue generating yet, or you haven't generated $1, come back when you do. It's not a one and done with us, right? We'll just sort of put you in the process. But I think that's a super important way to do this, because so many great entrepreneurs that think that think or know the situation is stacked against them won't even go through the process. And we do our best to try to be approachable. We're very direct. When we're not going to do something, we try to explain explicitly why. I mean, a great Julieism is, if you need an answer today, it's no, right? So you sort of start there, because when you raise money, people are nice to you. I did this. Everybody's like, oh my God, they're so nice to me, right? They must be interested. Yeah. And then if it doesn't come together, it's a little bit strange, and it's such a time-consuming process, which is also part of, Julie built all this out originally, which was, let's just be real clear. This step, this step, this step, and this step. Yep. Right. And if you don't make the next gate, here's why. So I think that's kind of how we've tried to be open and accessible.
So next question then, how do you go about determining valuation for these very early stage companies that have a little bit of revenue, but not a lot? They undoubtedly have beautiful projections. How do you determine if it's 5 million or 6.5 million, and how do you come up with that?
Sometimes it seems like
I'm dying to know the answer, because I don't really know what it is, even though I do the same thing you do.
It's a bit, Tom, of what will the market bear? But I think a lot of the valuations that we see are kind of, like,
yep.
But we see a range, right? And what was happening with a lot of the valuations, say towards the end of last year, is they were creeping up. So we were having more companies come to us with no revenue that had valuations of 5 to 10 million. We had, so, and in the Pacific Northwest, generally valuations were not as inflated as they were. But I think that, we tend to see valuations in the 3 million and below, 3 to 5 million, and then 6 to 10, and then 10 to 15. Those are the ranges. But I think some of it is what will the investor take, but we also are big fans of having the valuation be significant enough that the entrepreneurs are motivated to work for the return and the success.
Yep.
Yeah, there's a little bit of art and science in this. It's funny, got to know a guy who's an investment banker that kind of relocated to the area, and we were going through a startup thing, and And he's like, how can that company be worth $3 million? And I was like, well, because he's trying to discount cash flow it. He's trying to do a bunch of other, and I was like, look, the way this works is if you're going to take external capital, right, your valuation has to be high enough so that the founding team, the management team, anybody you may hire can participate in the upside. So when valuations on companies that want to raise money go, lower than, call it 2.5, 3, whatever it is, on a pre-money basis, which means no money's in yet, right? Then that can become, especially if that company raises more capital over time, and a lot of capital over time, the ownership share of the founder becomes very small. And then that's not, the incentives aren't aligned, right? They're doing the work, or the founding team is doing the work. So, seed deals are in that 3 to, I think of them in terms of bands, right? And, valuation is always negotiable and you can get around it. But like if you're a seed stage company, you got 2 customers and you come in and you're saying, I'm raising money at a 12 million pre-money valuation. What I'm going to say is, that seems high, right? If we want to invest, we're going to get into it and we're going to look at it relative to the price that we want to invest at as a fund, which we talk about as sort of this sub 8. And then it's based on stage of the business, but we're not coming in to try to really push valuations so low. So we end up creating a disincentive, for the team, down the line.
Yep.
So I don't know, that's not a clear answer to your question, Tom, but that's kind of how we kind of think about it.
It is more of an art than it is a science. And to me, I really kind of relate it to the residential real estate market, where you can look at comparable homes in the neighborhood. Yeah. Now, the only distinction between residential real estate and what we do is the information about these companies is not widely available. We, as angel and venture investors, we see a lot of deals and we know what the valuations were, the backgrounds of the founders, the backlog, the revenues, and we kind of have this informal database of, this ought to be on the higher end of the $5 to $7 million range because this is the entrepreneur's 3rd company. He's got a big backlog. And so that's, to me, it's really just, and of course there's market cycles where things get high and things get low, but it's really kind of valuation is relative to the last 15 deals you've seen in the preceding 3 months and how this specific company compares to that one in terms of stage, experience, the profitability of the business model. Does this company have really high gross margins or low gross margins? The size of the market. You could probably actually quantify it into some sort of weighted average metrics based on a bunch of qualitative data points.
Yeah. I think all those things definitely factor into it. And then, we haven't seen it as much in our market, but if you look at the Bay Area and you see a seed deal going into a company and it's a $5 million seed round, like the company has to then be valued at $10 to $15 million just so it doesn't completely dilute the founding team. And so there's this other dynamic which has happened, which is valuations have kind of come up a little bit because there's so much money trying to be put to work. Again, we haven't seen that so much. I think there's a level of sanity that's remained in 2 things. One, the types of companies that we want to invest in, but also kind of our region hasn't seemed to have gotten that. But yeah, there's a significant amount of art to it. And and then it's back to kind of supply and demand, right? If you have a bunch of people that want to get into something, then you're in a much better position to sort of demand your terms, versus if you're just trying to let, a fund or the market price it.
Yep. Oh, I'm sorry, Julie, do you have something you wanted to add?
I was going to say, one of the things that Robert was saying reminds me that we've, managing the fundraising process for entrepreneurs, it is a sales process, right? And one of the things that we found is that we'll hear from folks and we'll get updates, and then all of a sudden it's crickets for a period of time. And managing the process from initial contact through to actually closing the investment is an important thing to pay attention to in terms of communication and updates, what's going well, where you're stalled, all of those things. And those build strength in the business partnership over a period of time as you're sort of closing in on potentially doing an investment. Sorry, Tom, go ahead.
No, well, that's great. That's a great observation. And I think one thing that entrepreneurs don't recognize, that as we as potential investors are in that process as they're raising money, we are not only evaluating the merits of their business and the team and the market, but we're seeing kind of how they act during this process.
Yeah.
Are they do they have a sense of urgency? Are they following up? Are they negotiating well? Because those are all telltale signs about how aggressive they're going to be if we provide them capital and they're out there running the business and trying to sell product. And if someone is kind of lackadaisical and not negotiating hard and isn't terribly responsive, that's just a real indication to me that that's perhaps not a company I want to be involved with.
Yeah, I absolutely agree with that on so many levels. And like basics, like show up for the meeting.
Yeah,
which blows me away when sometimes people don't. I mean, come on, right? It's calendaring. Like, and because I'm not that important, or we're not that important, but like if I'm your biggest distributor, or I'm your biggest customer, or I'm a potential acquirer, right? Is that how you're going to do it? I think that something that's a hack that I stole from somebody else. I really have no original thoughts. It's just stuff that I picked up along the lines here. Like when you raise money, it takes some time, especially when you raise from a fund. And so what happens is stories are told about, I sat down with XYZ and in 5 minutes, they wrote me a check for $50,000. That can happen. That generally doesn't happen from a fund, because a fund raises money from other people and we have a responsibility to that money, which means we have to have process related to diligence and some other things, right? Mm-hmm. But what you can do as an entrepreneur, right, is that you're not always going to get your action. But if you think about this as a sales process, like having a discussion with an investor and maybe they're not committal, maybe they're not doing something, just ask them if you can put them on the friends of whatever your company name is email list. Right? And then put yourself in the discipline on a monthly basis to write an update email.
Yep.
Right? Product, customers, team, market, something, right? Bang, 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 bang. So you can kind of document your progress as well. And just BCC all those people, right? Give them the chance to get off the email or whatever it is. So it's personal accountability, especially if you're a sole entrepreneur, it's hard to stay motivated. So personal accountability in terms of your monthly, but also it begins to build an audience around your progress. Right. And so then it's like, wow, they're making progress. I mean, there's a company that I love their updates that is in our universe. I don't like the business, but I love the updates. And so now that's quite not moving the ball with me, but the fact that it's quantitative and it's clear and he didn't do it 2 times and stop. I just think that's a real good hack here. Because I think it's Mark Suster, one of these guys that blogs pretty prolifically about venture, whatever. He's got a post called Connecting the Dots, and it's about how do you build relationships with people who don't have a lot of time to build relationships. And this notion of the slow drip is so important. It's like a nurture campaign in sales, right? And then you build this message around momentum. I said I was going to do this. I did this. I said I was going to do this. I did this. And that's back to, Tom, your point in terms of execution and capabilities and all of that. And it's such a straightforward thing to do. And as an entrepreneur, it gives you an easy call to action at the end of a meeting. Can I add you to my list? Right? Anyway.
Well, let's flip that around too. So same for the entrepreneur with the investor. The investor blows you off several times. If they're unreasonable, there are tons of helpers out in the community that want to be mentors and then take some percentage of the business to make sure that they have accountability. So I think the due diligence goes both ways, although many times the entrepreneur really needs that money. So there's some compromising that goes on, but we always encourage, for example, when we're talking to entrepreneurs, we say, and we're considering an investment, we always say, will you just call some people that are in our portfolio so that you understand how we work and if you think that will work for you. Because the worst thing that happens is there's an investor, there's an entrepreneur, there's a great business, things are going really well, and then there's some fundamental disagreement later on, and it ruins the deal, right? And it ruins the process and ruins the deal and ruins the outcome. So I think that's another way to look at it as well.
Yeah, very, very good point. And again, this is back to things that we've, I guess, subtly I mean, when the money is invested, like that's as great, that's a high point of the relationship. Everybody feels as absolutely great about this as they possibly can. The investor feels really, really good about it. The entrepreneur feels, if there's something off at that moment, right, that's an indicator that something may be off in the future as well. And so it's like sometimes you can get on rails with something, whether you're dealing with an investor because you want the money or you're trying to invest, and then things begin to get weird.
Yeah.
Just important not to get blinders on related to, I have to do this because this is the path I was on, right? Just to sort of have a little more self-awareness to make sure that, look, this is as great as it's ever going to be, especially if your investor wants to negotiate over something really ridiculously stupid in a set of terms, right? And when you raise money, right, it's about kind of, it's kind of about governance and control and economics, right? It's like, how much say do I have in your business? Well, the way we are, check size, the stage we invest at, we don't take board seats. We want board observer seats because we want the flow of information. We're not going to tell you how to run your business. So we have information rights. We have those different types. And those are more governance types of asks at this stage. We're not going to dictate what your board of directors looks like. I think a lot of companies make mistakes early on when they have a bunch of angels, they have a bunch of early investors, and all of a sudden their board has 5 people on it, and they're going to go out and try to raise another round of funding. Well, that Series A investor or Series B investor looks at that board and is like, oh my God, I got to clean this up. Yeah. So that creates friction, right, in the deal. So if you think about, because all raising money is giving up rights, right? It's like I'm giving up information rights or I'm giving up control rights. And so, at the earliest stages or the size of check or whatever it may be, just be really, as an entrepreneur, I'm talking to that audience here, right? Just be really stingy about that. Be stingy about board seats, be stingy about these different types of things that sometimes are, specific asks that maybe not in the life cycle of the business are really going to benefit you.
Mm-hmm. Good insight. That's a good transition. I was going to ask next about structure, but before I do so, I just want to remind anybody else, if you have questions, jump in, raise your hand, reach out to me or Cindy, and we'll queue you up. But my question about structure is, you were talking about last year how you've seen kind of valuations creep up. Also, there's been a clear trend toward doing a convertible note versus a priced round. And I'm interested in what your views on that. Do you have a preference, or do you have a ban on convertible notes? And what's your thought about that trend and the pros and cons of notes versus a priced round?
Go ahead, Robert.
So we'll invest across the board. We invest in priced rounds. We invest in convertible notes. We invest in things called safes, which are the difference between a convertible note and a safe. A convertible note is actually a loan, but nobody wants interest. What you want is it to sort of convert in the future at a priced round, but it accrues interest, and safes can. Anyway, I think that I always think about this relative to the amount of money you're raising, because you just go back to lessons learned. I didn't raise a ton of money in the first round of money I raised. And I got a tremendous legal bill from not only my counsel, but the investors' counsel. And my transaction cost on a small sort of $1 million round was really high. This is a long time ago, right? What the benefits you'll get with a note, it's pretty straightforward. I mean, use standard docs, like the National Venture Capital Association has got a standard set of docs, a bunch of law firms, Wilson Sonsini, Cooley, right? They issue standard docs. So in the past, a priced equity round, you're actually selling securities in your company, could have a really high price associated with it from a transaction standpoint, right? $25,000, $30,000, $50,000. So if you're raising $300,000, that's a significant amount. So I think that's one dimension of this, which is to think about the amount you're raising relative to the vehicle. I know some folks that they think a price round has to happen out of the gate, and all that does, it lets us actually have a true value of what we own, so we can then report that for our back end. I mean, that's a little bit of benefit of it. So I don't know. There's a lot of mishmash in there. I mean, I kind of take it from the transaction, and they've come down significantly in terms of priced rounds. Like you can do a $500,000 price series seed round and not get eaten up by legal costs if you do it correctly, which means you've got counsel on both sides that know how to do these, which is super, super important broadly.
Yeah, I think what you're pointing out, Robert, is that the note is a little bit more flexible early on. It's a little less expensive, a little less time consuming, a little more straightforward. What I've noticed, and check me on this, Robert, but what I've noticed recently is a lot of the convertible notes that we're doing are with companies that have their Series A or their break even in sight. So they're raising money because they've got momentum and they need money to bridge into the next level. But I would say, in companies early on, it's just a little simpler to get a convertible note done.
Yeah, and the other thing you can do with that is, say you want to raise $750,000, and you want to do that on a note. What that allows you to do is go get a check for 25 here or 50 here, or 25 here or 50 here, kind of as you go through it, right? So in terms of utilization of your time versus when you're raising a priced round, I mean, the documentation is the same, whether it's for $500,000 or $5 million or $50 million. You're sort of trying to cascade everything up to a close date, which means you're trying to nurture and get everybody to wire their funds on the right date. What happens with notes from an entrepreneur standpoint, a convertible note, they're sort of sneaky dilutive. So nobody, like I said, nobody really wants the interest payment, but the interest accrues. So if you've got a convertible note that you've issued for $500,000 and it's got an 8% interest rate on it, well, that's going to accrue. And when you finally, price your round or raise a subsequent round, not only does that $500,000 price into your company, but the interest does as well. And so if you've listed a note and you've kept it open for 2.5 years or 3 years, you're getting, your cap table's not showing you how diluted you are. And I think that's something really to be thoughtful of. It's just they never were intended to be long-term financing tools, right? It's a way, I'm going to do this. And then there's this thing called a qualified financing event, which is this will convert when I raise $500,000 or $1 million. So that's back to plan and timeline. Because the last thing you want to do is extend a note for another year. I mean, it just, so think about it kind of in that regard. But sneaky dilutive is a problem with these things.
It's SD. SD, that's a technical term. And here's where I
got sneaky talent. I got sneaky dilutive. I got to come up with another one.
And here's where I should issue our
negotiating term sheets. You've got all sorts of great little terms. You must have a marketing background.
I do.
We should really issue our standard disclaimer here, which is that everything that we're saying today it's not legal advice, it's not investment advice, it's not business advice. These are our opinions, kind of based anecdotally on what we've seen in the market and what we've done.
Perfect. We have a couple of questions lining up here. The first one is from Justin Berg. Justin, why don't you fire away?
Yeah, sure. Thanks. And thanks, Julie and Robert. You mentioned that you invest in early stage startups, but that also you like to see companies that are showing some revenue traction, even if minimal. Can you comment on what might be the tipping point, whether it's strength of the team or coolness of the product, that may influence your decision to invest in a startup with little to no revenue?
Yeah, I think so. The team is a really important feature of that. Can they execute? And is the idea something that we think can actually scale quickly? Would be two that I would mention, Robert.
Yeah, I'm gonna.
Hi, Justin.
Go at the sort of like I try to think about what a company looks like at $1 million in revenue. Okay, so whether you're there or not, it's more like, what is your average sales price? What is your business model? Is that a recurring subscription? Is that a transaction fee? And so like if you have a company and you sell $300 average order value things and you take 2% of that, like what does it take to get to $1 million in revenue? Right? Because then that is a function, everything kind of falls out of that, right? So I'm not going to pick apart a set of pro formas and ask you in year 5, why are you spending $6,000 on online ads? I don't care about that. It's like, look, there's a revenue curve and there's a cost structure to this. And get the $1 million mark, I think it's reasonable to think about it. I think at like the $3 to $5 million mark and the 10, and then we can certainly use all sorts of hockey sticks for the future, right? But the true sort of economics of the business are going to fall out then. So that's what I think we would poke at, right? Is just sort of that. I don't know what your business is or what you're working on. And so I think that's one dimension of it. I think the other is, we always try to say, look, this is never a question of if you have a business or not, right? You have a business if you can sell it for more than it costs you to make it, which means you make profit, which means that goes in your pocket as an entrepreneur. What we're doing is we're building the investment case. The investment case says, again, back to compressing time, growth, and potential outcome, is this something we can put money into? Is this something that we think can grow aggressively within a 5 to 7 year time period? And we think in that 5 to 7 year time period, we can get a 4 to 7x on the money, right? And that's a lot of things outside your control, but that's like, okay, how many potential acquirers of your business are there, right? If there's one, that's binary, that's hard. That means that deal either happens or that doesn't happen, right? So those are a lot of things that begin to get outside of your control. So long answer to your question. I think back to what we try to do is make it pretty basic in terms of our 3 check boxes. So we generally do not invest pre-revenue, but if your trial, your usage, your data is blowing the doors off, like if you're something that people get into every day and they spend 7 hours a day in it and people come in and then they don't churn out, like you're onto something, right? So that's a data-driven way to sort of look at signal from the market versus it having to be, some type of revenue thing. I just think, a long time ago, I had an entrepreneur friend of mine that was, we were having beer one day and he's like, look, here's the thing about entrepreneurship, right? You have to visualize somebody taking $1 out of their pocket and handing it to you for the thing that you sell, right? And so having that gone through that discipline, I think is such an important thing for you, right? As much as it is for a potential investor.
What's your business, Justin?
So we've built an interactive podcast platform that provides a solution in the online learning space and a cheaper and more effective way to deliver distance learning.
Great. Do you have clients at this point?
We have pilot users, 3 different companies that aren't yet paying, but we hope to convert them to paid users very soon.
Great.
Yeah, so like in that case, it's like, okay, great, that's 3. So did they just sign up and they haven't done anything? Did they sign up and do one thing? Did they sign up and do 2 things? Did one of the 3 actually mainline this now and they've used it 6 times, right? I mean, I think those are ways you can begin to parse that's not necessarily related to dollars as much as it is, it's sort of pull you're getting based on what you're doing, right? And it's not just you trying to convince me of that. It's like, look, this is actually how they're using this and this is the value that they're getting out of it. And you can kind of wrap yourself on the data, right? In terms of usage, because I assume you can track all that on the back end.
Sure.
Yeah.
Well, thanks, Justin, for your question. And you're presenting tomorrow to the Spokane Angel Alliance. Looking forward to it.
We'll be there. Thank you.
Good luck.
Next up, Nick McLean, Odd Jobbers. Do you have a question?
Yeah. Hey, Robert.
Hey, how are you?
Good. How are you? We
Good.
we spoke back in January. It's good to reconnect here for a second. But so I was wondering, how do you guys view like debt on the balance sheet at a deal you're looking at? Because I think that a lot of companies, potentially us, see debt as a way for to kind of get ourselves to the next round at a point where the valuation will be a little bit higher. But I'm just wondering, if the if the business is sucking cash, how do you view investing in a loan that was taken in a year beforehand?
I guess my initial thought on that, Julie, unless you've got one.
I've got one, but go ahead. Yeah.
So when we invest, we want the investment to be used for working capital out of the gate, meaning not for debt pay down. Right now, sometimes there's some gray area in that it may benefit. I mean, there's sort of revolving debt that you may have on a credit card, so it's not that. But if you've got $1 million loan and you're going to raise $1 million and you raise that $1 million and to pay off that $1 million loan, you essentially have accomplished nothing other than removing that off your balance sheet. So I think that again, there's some nuance in there. Like that's my initial reaction. This, Julie, I don't know if you've got, you probably have more.
Yeah, that was my initial reaction too. So sometimes we see that, for example, founders have not taken a salary and they want to get paid back for 6 months that they didn't take a salary, or remove the debt from their balance sheet with the investment. And that is not, from an investor standpoint, it's just not an effective use of the money. Is that where the question is coming from, Nick?
Yeah, I'm curious. Like, I think that most companies, if they're looking at debt for some bridge financing, it wouldn't be a super, it wouldn't be a crazy number. So what kind of level of debt is stomachable, I guess, for you guys?
Yeah, a way to think about that, and we've done a lot of this work, particularly in the last few months with our portfolio companies, is can you show how you're managing that cash and how you will pay down that debt? So having a cash management plan and having a plan for how you will utilize the investment funds and how the debt will go down in terms of some kind of simple pro forma is going to go a long way. Because you could potentially, I mean, I don't recommend this, but there are companies that carry quite a bit of debt, but they can show and they can make a compelling case that they have a method for managing that. So if you just have the debt on your balance sheet and you don't really know how in the heck you're going to pay it back, that would be troublesome, I think, to an investor.
I might have some unique insight into the question that Nick is asking. And in Nick's situation, it would be a modest amount of capital. It would be termed out over like 5 years. So I believe, frankly, a new investor, when Nick is ready to raise his next round, will look at him and say, hey, good on you. You raised, a modest amount of non-dilutive capital that has a payoff of modest monthly payments over the next 5 years.
Well, that's a great point. I've done both. So I've had external investors, and I bootstrapped and taken on debt from traditional, like the first business I started, let's just say, I decided I would not take out more equity than I had in my home. Like I just, so I carried some pretty significant debt in that company. It does, and then paid it down, and it shows that you've got the moxie to leverage that capital, right?
Yeah. And just a more dramatic point on this, which is if it's $100,000 loan from you to the business that you're raising money to pay back, right? That's a problem. If it's debt service, 5-year term loan, right? I mean, think about this. If you run a business, you lease computer equipment, that's essentially a debt, right? But the maintenance of that is basically business operations. I think at the highest level, I don't know an actual number to give you, but I mean, if you've got $17 million in loans at this stage, right, that may be a negative signal because you're off a little bit. You know what I'm saying? But to Tom's point, right, which is, look, if this is just something that's put in place, because it benefits you, because you haven't had to sell part of your business to make it more valuable. And now when it's time to sell part of your business, think about fundraising as that. You are selling part of your business. Your goal as the entrepreneur is to have that price as high as possible so you sell as little as possible. And if you can get there through, sane and pragmatic and smart, business operations, then go for it. I don't think that's negative at all.
Absolutely, yeah. I wish I had $100,000 to lend to my own company.
No, yeah.
Another question from Rick Rep, and Rick is one of the senior partners at a law firm here in Spokane, Witherspoon Kelly, and Rick is involved in a very large number of the financings related to our emerging companies here in Spokane, and is clearly someone you guys should be mutually introduced to. So with that, Rick, go ahead and ask your question.
Well, thanks, Tom, and thank you, Julie and Robert, for all your insights. This has been great. I like how you're transparent about your process. I sort of have a two-part question. One, you mentioned that you're focused in Bend, and I wondered if you could sort of update us on the profile of businesses that are really startup businesses that have been successful in Bend, because I'm sort of carrying around, I've been to Bend, but all I know is that they've had some outdoor tech or lifestyle type businesses that have blown up and gone big, or I don't know what's currently hot and happening there. So I'm curious about that. And then I'm also curious about, you mentioned your willingness to invest in the greater Pacific Northwest, i.e. Washington, Idaho. I'm wondering if you're willing to share, examples of companies that actually compelled you to come out of Oregon and come up here?
So the business is our business is based in Bend, but we really are, we originally were an Oregon first investor, and we broadened that footprint kind of opportunistically. And then we realized that there's just a lot of good opportunities that we want to have, line of sight to. So what we're seeing in Bend right now is there has been a concerted effort in the outdoor products industry. We don't have any investments in that at this point, except, well, actually one, which is called Cairn. It's a subscription box company that delivers really great outdoor gear to its subscribers. What we're seeing now is we've had a slowdown, I think, in new startups. And most of the companies that are tech and say in the emerging growth category are actually tech related companies. So I think that one of the things that we're really watching closely is what happens with new starts at this point, and what happens with the seed stage companies during this uncertain period. I mean, all periods are uncertain. This just has more uncertainty factors, but I think that the companies that we've invested in the last few months are all companies that we've been in conversation with over the last year or so. And so it'll be interesting to see what happens over the next year in terms of startups in Bend.
Yeah, so there's if I think about just our software, and I'll talk about software around Bend as well. So we're invested in a company called Lead Method, which is a software business, a company called 10.ai, which is in sort of the robotics software space, InvestorPro, which is in the HR software space. So these just happen to be companies that are software companies based in Bend, not necessarily Bend companies. And then in the outdoor product space, as you said, there's we're invested in Cairn, which is in the subscription box business for outdoor products. But there's a lot of outdoor products here as well. Bend Outdoor Works is kind of an outdoor products incubator type thing. And then this just gets back to a lot of those are great businesses, but are those the types of businesses that can compress based on time and based on scale and kind of generate, even for our fund size, right, the return profile. This goes back to sneaky talent, Tom, we were talking about ahead of time. There's just a lot of people that have moved to Bend from San Francisco, from Portland, from Seattle, where I lived for 15 years, that have decided to make this their home, that not only are starting companies here, but have skill sets as product managers, as software engineers. And so there's an ability to build that here. Your question on how have we sort of diversified around the region. So we've got two investments in Seattle. One's a company called Stabilitas, which is in sort of the corporate security space. And the other one, it was the first investment out of this fund that we're in currently is called Intuitive, which is in the really sexy claims management space for software. One of those has an exec in Portland. So, sometimes it helps us to pencil a little bit to have a connection back to Oregon, but it's certainly not something we need to do. We've looked at a couple opportunities in Boise, and again, we've looked at some stuff in Spokane as well. So I think that from our investor standpoint, that regional diversification is important because that will give us a much richer portfolio. And also, we just fundamentally believe in the investment case for great businesses can be built in places like Spokane and in Bozeman, right? And Missoula and places like Bend, where, it sucks to call them secondary cities or second tier. We don't think of ourselves that way. But there's two schools of thought in the investing world, I think, right? One is everybody's got to be in the same place and it has to be in the Bay Area to maximize return. The other is you can build a great company anywhere and you can leverage talent and skills anywhere. And I think I lean a little more towards that side, right? Which is you can build a great company anywhere, given the outcome profile we're looking for, right? We're not looking for, a $5 billion opportunity. We certainly would take it. But we think that great companies can be built and great exits can happen in this, $30 to $80 million range, regardless of location.
Thank you.
Excellent. Well, it's 1:00, and so we want to be respectful of everybody's time. But I think a couple of questions that have come up is when is the next time you're opened up for applications?
Yeah, we're kicking around the date on that. That'll probably happen the second week of August is what we're
Okay.
thinking. And then we'll just leave that open through the end of the year. So we'll certainly, Tom, you'll get, I think you're on our email list. Hopefully I don't hit you with too much.
Yep.
You'll get an announcement when that happens. And then literally Gust is this platform. We try to make that pretty frictionless as well, right? It helps us manage the workflow mostly because when we do these, we'll get 50 or 60, applications during a couple-week time period, and we're trying to just make sure we get are responsive to everyone. But we'll do that. And then again, we're always interested in looking at interesting things, right? So, my email address isn't hard to figure out. It's just Robert@Cascade Seed Fund. Julie's is similar.
Mine's harder. It's Julie@Cascade Seed.
I didn't want to give your email address out just in case you weren't ready for that.
No, I'm good.
Happy to take a look at stuff, right? And again, you kind of know our filtering mechanisms that we're gonna look at.
Good. Well, this has been very helpful, very insightful. It's good for us in Spokane to have a better understanding of what you're looking for and your kind of insights into the fundraising process and deal structure is also very helpful. If you find yourself in Spokane, either one of you or both of you, please let me know. And, I'd be delighted, one, to make any introductions that you'd like to have, and two, maybe get a group of this together in person for a beer or coffee somewhere and have a chance to actually meet face to face. So let me know when you're next in town.
Yeah,
Thanks
we'll
for the
do.
opportunity, Tom. Really appreciate it. Yeah.
Yeah, for sure. Yeah, this was great. I hope it was worthwhile for everyone.
Perfect.
Yeah.
Perfect.
Yeah.
Well, thank you, everyone. And I know some of you might be signed up for the Spokane Angel Alliance meeting tomorrow, and look forward to seeing you there.
Awesome.
Okay. Thanks everyone for your time. Really appreciate it.
Yeah.
Thank
Thanks,
you.
Tom. Appreciate you
Take
having
care.
us.
Be well.